So yes, well, thank you very much for attending what is our third webinar of the current year. So we did lots of webinars in the pandemic, and then we had a very fallow period where we didn't really do too much. And now we're back with a vengeance, doing lots of webinars on lots of exciting subjects. This not being one of those exciting subjects. We've done two so far, P45s, which is riveting content. I'd like to say well presented, but perhaps not. And then we did one on new starters, which was very useful, went really well, lots of good content. So, that certainly was a worthwhile one. It's apt that we should be presenting this on the 18th of April because the 18th of April is indeed Tax Administration and Maintenance Day. So announced in the early year budget, spring budget, that today was Tax Administration and Maintenance Day, otherwise known as Tax Day. And in theory, it's when the government released a lot of really exciting consultations, etc., to get all our juices flowing, and are all excited about how they're going to streamline the tax process. So accountants probably get more excited than us, but it's fitting that it should be on this day that we do our webinar. So today is geared around tax year legislation updates. So it's legislation and changes that apply to the current tax year and that are relevant to the forthcoming year, or in the case of payroll and the benefits, years. So we're going to look through the riveting content first. I was very much looking at whether I should do good news, bad news, good news. So we went with bad news first, which is the tax and student loans, then the good news, which won't be news to anyone, about national insurance. We'll then look at the national minimum wage and national living wage. So some fairly significant changes there, although most people will already be working with them. But the extension of the national living wage to a younger demographic was obviously important, and for some means a very significant increase. Holiday pay and entitlement, the new legislation on holiday pay and entitlement for casual workers, workers without regular hours, 0 hours workers, whatever you call them. Their holiday pay has been a problem for years. Everyone has a system to deal with it. You would struggle to be compliant because the legislation and guidelines are riddled with holes. So there have been attempts to smarten that up, so we'll cover that. Statutory paternity leave, significant change there, although it's something that is not that common, but it does allow some greater flexibility with that. P11Ds and payroll and the benefits in kind. So we're kicking off that subject. That subject is going to be uppermost in our minds for the next couple of years. I suspect it's going to be talked about, it's going to be debated, and it's very, very significant for a payroll bureau such as ourselves, and also for accountants and other providers. It's caused a great deal of discussion within our circles, and we intend to extend that discussion outwards so other people get to discuss it too. And then some other changes that are on the horizon around automatic enrolment and RTI changes that are at various stages of their journey to becoming legislative. So they're on the horizon. Likelihood is there's 2025. But if you don't study payroll or keep up with it, then they're pretty relevant. They'll have an impact on costs. They'll make some things simpler and undoubtedly other things more complicated. So that's a summary of what we're looking to cover today. So as I say, we looked at the really bad news first, I guess, because tax rates. What's to say about the tax rates this year? Not a lot, which has been the case now this is the third year in succession where the personal allowance has remained unchanged, which is the most significant part of what we do in payroll. Tweaks around the edges have happened in those previous couple of years in terms of the rate of tax and the higher rate of tax when it comes in, etc. But in essence, there's been no budget giveaway this year in terms of tax rates. It's been done in other ways. So 3 years unchanged. who knows what's on the horizon. As payroll professionals, we were very used to receiving at the beginning of each tax year the changes to the tax code and updating everyone's tax code with the relevant adjustments. But that's become a thing of the past. It's etched on everyone's mind. 1257L is the standard tax code. Everyone knows it within the business. You don't have to adjust your mind to a new tax code every year. So it's from a simplistic approach. It's very nice. Student loans, again, some tweaks there. So Plan 1 and Plan 4 thresholds have increased by 13.5%. So that's quite significant for someone who's paying off a Plan 1 or a Plan 4 loan. Plan 1 is the oldest type of student loan, and a Plan 4 is a Scottish loan. Plan 2, which is a more recent loan type, and postgraduate loans, the thresholds there remain unchanged. And the recovery rate for all of them, so the rate at which you repay the loan once you exceed the threshold, again remains unchanged, and it's currently 9% for Plan 1, 2 and 4, 6% for postgrad loans. So again, unchanged those rates of recovery. So next slide then, Daniel. NI table letters. So I've mentioned these because we've become used to a real alphabet soup of new national insurance letters. For those of you old enough to have watched Sesame Street when it was brought to you by the letter A or the letter Z, the NI legislation changes have tended to be a bit like that in recent past, with new NI letters introduced pretty regularly. When I first ran payrolls, there were probably 3 or 4. Now there are approaching 20, I would imagine. I haven't counted them, but you've now got Freeport workers and veterans and apprentices, and obviously you've got the age-related ones. So it's been an absolute joy to deal with different NI letters. It could be that they're running out. They'll have to consider, it's a bit like number plates, I think. When you run out of number plates, where do you go? When you run out of NI letters, where do you go? So maybe that's why they've given it a break. All those brains that get involved in such exciting things probably are occupied by other things. But the really exciting news, obviously, that everyone is aware of, is the employees' national insurance rate, the primary rate of national insurance, which has been reduced by another 2% to 8%. So when you considered it, beginning of January, it was at 12%, and now it's at 8%. That's pretty significant. Prior to that, it hadn't changed for years and years. But there is clearly now a gradual, and it has been declared that the intention is that over time, national insurance will become a thing of the past, and that it will all be recognized as some form of tax, which makes sense. National insurance as a standalone, restricted pot for certain areas of the economy is long since departed. It is a tax under another name. And it's something, and it's more complicated than tax, really. Tax is pretty simplistic. You get a load of income, you pay a load of tax. Employees' national insurance is more complicated than that. You only have to ask a director who changed their NI letter mid-year and was on the director's national insurance calculation method to explain that to a director where it's happened. It can take a significant amount of time and energy because it is extremely complicated. And other areas of national insurance are complicated too. So any simplification of national insurance would be gratefully received by ourselves. Employers' national insurance is unchanged. So what you pay for the privilege of employing people, that hasn't been reduced. So you still get to pay the same amount of money to as a bonus for employing people. So that's great. NI thresholds are unchanged, so all the thresholds that we deal with day in, day out that perhaps you don't see. There are numerous thresholds within national insurance. Each band of earnings is treated differently. Some of it is specific to employees or employers or a veteran or a Freeport worker. So at least they haven't changed. They haven't been simplified in any way. And the employment allowance I haven't mentioned on there, but where employers are in a position where they can reclaim the employment allowance, that being a rebate of employers' national insurance. So the first £5,000 of employers' national insurance is paid for by the government. So that hasn't changed. It's still £5,000 a year. I know that many or most or all of you will have received recently an email asking you to declare whether you're eligible or not. And I know for some it'll be frustrating when we can clearly see that you're not eligible. You know, if your national insurance is exceeding 250, 300,000, then clearly you're not below £100,000. The reason we send it out to all is because really to highlight and make it visible. We get asked time and time again, have you claimed this? And for those who don't get to claim it, it just makes sure that they're aware of it and it's been a conscious decision not to claim it. And when the auditor asks or when someone else asks, the answer is to hand. And for those who are eligible, in days gone by, it was carried forward from one period to the next. You declared eligibility day one, and it went on for years. Now it's a finite thing. You declare eligibility 1 year, you then have to repeat that declaration year on year on year. So again, and we would never presume that we know about the structure or setup of your business. So much of the eligibility is about whether you're a connected company, whether you're connected to other companies. And very often we don't know. We'll make assumptions. We'll think we know. And we have clients where it's fairly obvious, we would think, but we wouldn't wish to presume, nor are we qualified to presume. So that's the reason we send those out. So next slide then, Daniel. So national minimum wage and national living wage changes. So national living wage extension to people over 21. Previously, it was people over 23. So that's a fairly significant increase for some groups of workers. You can see that apprentices and under 18s, 20% plus, 15% for 18 to 20s, and around about the 10% mark for everyone. So, you know, when you consider now, obviously the cost of living has been and gone, but this is, I'm going to put you in a slightly better position. It's a fairly significant increase. If your employer tells you that you're getting a 10% increase, you're probably going to be quite happy with that. I think across the increases that become effective in April, we've seen, you know, 4 and 5% is kind of the mark where it seems to be sitting. So, you know, where you have a predominance of lower paid workers and you're paying at or around the national living wage, then obviously that's going to have an effect. A couple of non-apprentice rate. So the apprentice rate applies to apprentices on a recognised apprenticeship framework. So you can call someone an apprentice. It doesn't mean they'll be an apprentice for the purposes of national minimum wage compliance. The apprentice rate applies to apprentices who are under the age of 19. And if you're over 19, it applies for 12 months. So it's infinite if you're under 19, but it is a finite period of time if you're over 19. The date the national minimum wage becomes effective, this always causes some interest with some businesses, clients, pay periods. The national minimum wage is effective for the first relevant pay period in which the 1st of April sits. So if you pay, as some do, from the 16th to the 15th of the month, or the 21st to the 20th, then you are not under an obligation to apply that national minimum wage until, in those cases, the 16th of April or the 20th of April. Sorry, 15th of April. No, 16th of April, 21st of April. Anyway, you get what I'm saying. So sometimes if we have a clear, yeah, we'll get split pay rates. So it'll be apply this pay rate from the 1st of April, which is not absolutely necessary to remain compliant. obviously there are pluses about it. Everyone expects it. And so applying it from the 1st of April, why would an employee be interested in when their relevant period began and ended? Quite frankly, they wouldn't. So in that sense, it makes sense. But it can create confusion and disharmony. And sometimes, it's not clear cut. So we would normally remind you that there's a national minimum wage increase due. Well, our normal approach is to increase the rate to a compliant rate where we know enough to do that. Sometimes we don't know enough. Sometimes other more complicated things are involved, like commission payments, other payments that would inflate the rate of pay calculated above what it appears to be. So it's not always straightforward, but the aim of the exercise would always be to ensure that where it's obvious, we up rates to comply, and we'll tell you that we've done that. But obviously, it's very much a two-way street. You need to keep an eye on it too and make sure that those increases are applied. So that's national minimum wage. Now we get on to more exciting stuff, certainly more exciting for us, holiday pay and entitlement, because ever since the case between Harper Trust and Brazel, which was around a music worker who worked part of a year and who had for whom holiday pay had been calculated, or holiday entitlement had been calculated on what would be deemed by almost everyone concerned, including the judges in the case and the various judges, because it went to the Supreme Court. So in payroll, most things are about fairness and consistency. And I don't think you find many people who would argue that she hadn't been paid fairly. And there had been a consistent approach, but in legal terms, and as obviously it took a great deal of time to decide, it was deemed that she should have been paid using the language and legislation as it was, which resulted in an inherent unfairness, which is fine and dandy. But for us, it meant that what was previously a relatively well, it was workable. Holiday pay has never been simple, but in some businesses scenarios, people on a standard salary, it is quite straightforward. I wouldn't seek to make it anything but there were lots of cases, lots of businesses, lots of scenarios where it was very difficult to calculate holiday pay. The most obvious one was for workers working irregular hours, and in Mrs. Brazel's case, a part-year worker. So now there are some changes which are effective from the 1st of April. And they came as a result of a consultation exercise, various working parties, round table sessions, consultation with those affected. The consultation was a bit of a one-way street because the feedback was based on questions. The questions were prepared by the relevant department, used to be the BEIS, but it then changed its name. So it was weighted in the direction that it was intended to go. But I think it's ended up, certainly for regular hours workers and part-year workers, we're in a better place than we were. So calculation of holiday pay, you are now allowed to use the 12.07% of hours worked calculation method, which anyone in payroll will be overly familiar with. Anyone who is involved in HR and part-year workers will be familiar with it. It was a very common methodology which was applied across the board. ACAS recommended it, and it was used. And then when the case of Harper and Brazel began, then we saw 12.07% and any reference to it completely disappear from ACAS and other bodies where you might seek guidance and reference. So it completely disappeared. Then it came back. Then it completely disappeared with the proviso that it was unlawful. So it was even more kind of castigated and something you definitely shouldn't have used. And now it's back. So welcome to an old friend. It's good to see you. So 5.6 weeks is a simple number, and it's derived from the calculation I got there. So it's 5.6 weeks divided by 52 weeks minus 5.6 weeks. So what you're doing is you're accruing the 5.6 weeks over the weeks that you work. So, and there are different percentages that we would use, although in a compliance sense, they're not as important. Contractually, they may be important. So that, if they were entitled to a different, 5.8 weeks, they're entitled to 29 days, then the percentages change. If they're entitled to 25 plus bank holidays, 33 days, an increased percentage. So you can apply that percentage to any worker in any scenario, and it works brilliantly. So accrual of holiday entitlement, there's another change there. So you now have the option to pay when holiday is taken, which has been what you had to do prior to these changes. You had to pay the holiday when it was taken. It wasn't permissible to use what is termed rolled up holiday pay because it was previously deemed contrary to EU law. But of course, now we're gradually separating from the EU. The government is sunsetting the legislation that is written in EU terms and substituting it with UK legislation. So this is one of those situations where it's been rewritten. So now you can use rolled up holiday pay. Rolled up holiday pay is very useful if you have a very flexible workforce who, they may be very seasonal. They may work, very intermittent, irregular hours. It allows you to include the accrued holiday pay, which you can now easily calculate based on 12.07% or an appropriate percentage. And you can add it to their pay for the period. And you can say that, okay, the job has been done. That employee has been paid for their holiday. It's all done, dusted, sorted in the same pay period, which is great. Lots of people have, and the government recognized within their consultations, lots of businesses continued to use rolled up holiday pay and 12.07% throughout its, the period of time when it was bad. It was something that you shouldn't do because there was no workable alternative. Ultimately, fairness and consistency, they were getting a fair and consistently applied amount of money relating to their holiday, and it worked. Because the difficulty with irregular and part-time workers is if everything is 5.6 weeks, 5.6 weeks, if they don't have irregular hours, then 5.6 weeks of what is the inevitable question. It's the question that everyone has struggled with. The guidelines were littered with refer to appropriate legal advice. So ultimately, this goes some way to solving the problem for irregular hours and part-year workers. There's also an enhancement to the right to request flexible working. So I mention it as an aside, really. It's if someone requests a change to flexible working and that request is granted, then it could affect your working hours, your holiday pay calculations. So it's something to bear in mind. Next slide, Daniel. Other considerations. So the changes have only gone so far, unfortunately. So rolled up holiday pay and the use of 12.07% can only be paid for irregular hours and part-year workers. So there's a whole group of workers who are perhaps not irregular workers. So typically there'll be someone who, because one approach to the previous difficulties was to turn your irregular hours workers into regular hours workers. And I know of some big entities that adopted this approach, which was to say, I know they're working irregular hours. What are they likely to be working? And we'll base a contract on that. So, they might base a contract on 5 hours a week, 10 hours a week, something that was not necessarily representative, but provided a framework around which you could hang your legislative requirements. So it would have been nice, and those still present difficulties. So if you're in a position where that is truly the case, someone's working 10 hours a week, and then they work maybe, you know, another, in a band of another 20 hours, which is very irregular. So they work 15 hours one week, 30 hours the next, 10 hours the next. Then you've still got all the difficulties around calculation of holiday pay that you had previously. You've still got to refer to a minimum of 52 weeks up to a maximum of 104 weeks. You've got to calculate the averages and their rate of pay and all the rest of it. So it's done nothing to address the problems, the difficulties that those people present to businesses and ourselves. The extension was considered, but other categories are not included. So they were expressly not included. It wasn't like, can we assume that they are? It's expressly stated that they are not. So those, and then of course, what is an irregular hours worker? So an irregular hours worker, and this is straight from the relevant definition, is a worker whose hours are wholly or mostly variable under the terms of their contract. So the inevitable question then is wholly or mostly? Well, black and white, it certainly is not. It's grey. And greyness means legal challenges. Greyness means the reliance on case law over time to determine what we're actually talking about. So all those caveats that exist where refer to appropriate legal advice will still apply to these type of workers, potentially. There are still plenty of cases around that, what was normal working hours was a phrase that was used previously. And, what is normal, what is wholly or mostly, ultimately very difficult to determine. If it's difficult to determine, then there's only one route, and that's courts. Someone somewhere will decide it's a battle worth fighting, and we'll fight it. And then at some point it will, filter down as a change. So that's holiday pay and entitlement, Daniel. Statutory paternity leave. So just other parental leave rates have changed as they always do. So they have increased maternity pay, shared parental leave, all those type of rates of pay have changed, and paid paternity leave has changed. So we always find ourselves at the beginning of a tax year learning all the rates. SSP, of course, has changed. So all of those things that we knew off by heart a month ago, we now have to relearn because they've all changed. But there is a change that is relevant to paid paternity leave, which is that previously paid paternity leave could only be taken as a 2-week block. So it had to be 2 weeks, and it had to be taken together. So you couldn't take 2 weeks separately. Effective from this tax year, you can now separate those 2 weeks. They must be within 52 weeks of the birth of the child or placement for adoption, but you can split them. So you can have 2 separate weekly blocks as opposed to having to have 1 2-weekly block. There's also a reduction in the notice period required for notifying your employer of your proposed paternity leave, offering more flexibility and accommodating last-minute changes. Well, of course. So that's good news. So that's that slide. Now our favourite subject at the moment. So why are we talking about P11Ds and payrolling benefits in kind now? We don't tend to talk about them. I've not talked knowingly of payrolling and benefits in kind for a long time. It's been in the wind since 2016, I think. The payrolling of benefits was implemented. It was implemented for some benefits, not others. It didn't work particularly well from day one. And over subsequent years, it has been expanded. The scope of the payrolling of benefits has been increased. So it includes nearly all benefits now. Not all benefits. There are a couple that are still excluded, but most of the common benefits are now included. And ever since payrolling of benefits in kind was first mooted, there has been talk that it would become a requirement rather than an option, which is what it has been to date. So you can choose the payroll benefits, and I'll take you through some of the advantages of that shortly. If you've ever been to a P11D webinar with me before, you'll find that I certainly felt that the advantages of payrolling were probably outweighed by the disadvantages. And the advantages of P11, there are advantages to payrolling the benefits, no question about it, but there are also some significant difficulties, and some of the perceived great things about it are perhaps not wholly true. But now there is no choice. From the 6th of April, the mandatory payroll in the benefits will take effect. So from that point on, it will be a requirement to deal with your benefits in kind on a monthly or weekly or fortnightly basis according to your payroll frequency, and it will be included within the payroll submission, the RTI submission. So what it means is that an area that we're involved in P11Ds to a fair degree, but we've never actively sought to do them particularly. Some accountants do P11Ds, and good luck to them. We wouldn't want to step on their toes by grabbing their P11D business. And similarly, some clients do it themselves. And, if it works, if it isn't broke, why fix it? So we provide a service, we offer a service. If it's used, it's used. If it's not used, it's not used. Well, that will change. From 6th of April 2026, that option will no longer exist. It's unlikely your accountant will be able to do them, because unless they're doing your payroll, because it will need to be done through the payroll. And if you're doing them yourselves, again, it's unlikely that you'll want to do them or be able to do them. One of the difficulties we've always had with it is that you employ us as your payroll agent, consultant, people who do your payroll. Reasonable expectation is that we would deal with, if you want to payroll your benefits, it's clearly a payroll matter, and that we would deal with it. Unfortunately, in the real world, HMRC wouldn't allow us to deal with it. We couldn't register for it. So we would say, go back to you and say, yeah, we know you're a payroll agent and all that, but you've got to do this yourself. And then when it came to actually recording, monitoring, and submitting those benefits, again, it's pretty reliant on client doing it. And we as their agent couldn't get involved in it. We couldn't speak to HMRC on your behalf to deal with matters relating to benefits in kind. So it put us in a difficult position, which is one of the reasons that we've not pushed it, not really seen it as a great solution. Another reason for that is that it's not widely used. Lots, particularly in the small to medium sort of enterprise employer market, it's not regularly used. A lot of the software systems that would deal with it weren't particularly well developed, didn't work particularly well, and HMRC, and it didn't work particularly well. There's an education process and all the rest of it. So it's not something we've actively sought to do, even though it probably would have benefited us to do it. So it's all part of the HMRC grand plan to digitalize the tax system. Obviously, I mean, it makes sense from their point of view. Several million P11Ds a year were submitted. Until fairly recently, they could be submitted on paper. So last year was the first year you couldn't do a paper P11D, but they're submitted. They were a tangible thing. They were a piece of paper or a digital submission that had to be dealt with on an annual basis. That then had to integrate with the tax system and get the right coding notices to the right people promptly after the 6th of July deadline. So anything they can do to have less involvement and make it more automatic is clearly a good thing from their perspective. And from all our perspective, we all have a bit of automation where it makes things better, don't get me wrong. It will remove the requirement for annual filing of P11Ds and P11DBs. So your P11D that you give to your employee, and the P11DB, which is the overall summary of the Class 1A national insurance liabilities associated with those P11Ds. What it doesn't do is remove the P11D becomes something different, but very similar. It becomes a statement of uh, benefits, expenses and benefits. So it's a statement. You still have the same obligation to tell your employee what you've payrolled as a benefit. So in that sense, because you'll see in a minute that they really do the big sales pitch on this is a great thing. But when you scratch the surface, there are lots of improvements and enhancements they need to make before April 2026. And they are committed to to having the working parties and the working groups and consulting with the industry and all the other things that will, in theory, reduce those barriers and make things better. And that's going to happen. They're finally going to allow payroll agents to set people up on it and manage it. I understand effective May or June this year. So they're taking some steps that will make it easier for us to do. But we're not going to have a choice. So we will do it. So that will mean that every time we make an RTI submission, we will be reporting the due amount. So how much is due on those benefits, and it will be collected. So it'll be collected from yourselves or your employees. So it will become a real-time collection process. At the moment, it's dealt with annually. You can do your P11Ds and then you sleep for another 11 months and you think, oh, P11D time again. There will be no sleep once this comes into being. It will be quite an involved process. I put hugely significant because I think it is probably the most significant change since automatic enrollment. It's a massive change for us and for employers and for employees. It will change the way. There are some pluses, there are some minuses, and we'll go through those on the next slide. So these are some of the benefits extolled by HMRC and in making the case for payroll and the benefits to become mandatory. So they say it's going to create a reduction in the administrative burden. And that's going to happen because it eliminates the need for the extensive paperwork associated with P11D returns and P11DB forms, resulted in substantial time and cost savings for businesses. So they're not looking to save themselves money, they're looking to save you guys money and us. Small businesses are going to benefit from this. I've yet to be convinced how the need for extensive paperwork is going to be reduced. I see it very much as, at the moment, if you have the most common benefit is private medical cover. And at the moment, a P11D, at 5th of April, you can go to your private medical provider, ask for a statement covering the period 6th of April previous year to 5th of April this year. They'll be able to do it. It's all in one place, listed by employee. We'll do the P11Ds. It's reported, done, dusted, put to bed. If someone's left during that year, the benefit will be adjusted accordingly because that's what you've paid. It's based on a real premium. So it's happened. The extensive paperwork that's going to be eliminated is one single statement. And what you get in its place is a raft of spreadsheets where you'll have to deal with the month-on-month private medical premium. You'll have to work out who started, who left, the effect that's had on the premium. You'll have to reconcile it. You have to make sure those changes are recognized. You'll have to deal with every new joiner. Have they joined that scheme? When did they join it? Etc. etc. In my mind, I feel there might be a little bit more paperwork associated with the new process than the old. Personal opinion. Increased accuracy. I can see an argument for increased accuracy. I think what it will do is it'll become part of the conversation on a month-by-month basis. At the moment, we do P11Ds once a year. We inevitably ask the questions about what was that benefit, who paid for it, who procured it, was it arranged by the employee or the employer? All those type of questions which are relevant to how it is taxed and how it is how the Class 1A national insurance is paid on it. what it will do is those sort of questions will become part of the conversation on a regular basis. You won't, you'll know that every time you add a benefit, that needs to happen. You need to know these things. So I think from this perspective, it is going to be a plus. Or certainly not a negative. I don't see a downside to it. I think it's, if people understand it, deal with it more regularly, people understand it better. If we have a new person join the business, you put them on a weekly payroll first because they do it 4 times a month instead of once a month. It gives them exposure, experience, etc. And I feel the same thing is true of benefits in kind. That exposure, that constant dealing with it will make people better, and it will increase the accuracy. So that's that slide. Real-time reporting. This is definitely a benefit. At the moment, there's the potential for an employee to receive a benefit and not be taxed on it for a significant period of time. So private medical cover, if they started it in April and you did your P11D on the 6th of July, then your tax code is likely to be adjusted 16, 17 months after you get the benefit. And there'll be a tax bill to pay. That tax will need to be paid. And as a consequence of that, you'll end up paying more tax when they finally catch up with the benefit. So there's no question that an immediate inclusion of that benefit and being taxed on it immediately is going to be better. This has always been a benefit of payrolling benefits in kind. You have to set the benefits against the difficulties involved, and there's no question that this is a real benefit. And then simplicity and efficiency. The new process promises a simplified and efficient approach to managing employee benefits. So kind of, what I said previously kind of applies. I don't think it's going to become any simpler. I suppose, you will, you're dealing with it more regularly. You'll become more familiar with it. You'll have systems and processes built around something that's happening on a month by month, week by week basis. So over time, I'm sure it will become efficient. So yeah, it's a mixed bag really, and that's really because it's a mixed bag. And overlaid on top of that, you've got a situation where introduction of any system by HMRC generally has some issues relating to it. RTI clearly had issues relating to it, and they've admitted that there are certain benefits that can't be included currently. There are some difficulties in the way it actually works. So I think that we haven't really focused on this now. What we'll probably be looking to do is you've got the option to go early in 2025, but I'll come on to that on the next slide, Daniel, I think. So there is no question that preparation and planning, we all know what prior preparation and planning do. There'll be a lot of consideration will need to be given to this over the coming months about how we're going to deal with it, the type of benefits that you will provide or don't provide. I keep talking about icebergs and 87% lying below the surface of the ocean because I feel that I don't think it'll be 87% lying, but there's a good 50% of P11Ds benefits and expenses reporting that we are not involved with in any shape or form currently, and we need to measure that, and we need to we need to know that in advance of when it finally happens. So over the course of coming months, we'll be looking to determine the type of benefits those who provide them give, and who many have told us that they do P11Ds via other routes, because every year we let people know that we will do P11Ds. We need to know whether they need some benefits reported and they engage our services, etc. And we get a number come back to us and say, no, we're doing it via route X, accountant, internal, whatever it might be. So we know some people have them. We can also tell from tax codes, if you've got a predominance of strange tax codes, it's usually because there's a benefit sat there somewhere. We'll be looking to establish the number of P11Ds that are currently filed for each organisation to get a handle on the workload. We need to kind of know what are we going to be dealing with when it finally kicks off. And the intended start date. So mandatory from April 2026, but obviously there's an option to go early from April 2025. You have to register to do it in advance of the commencement of a tax year. So by the 5th of April. And to make it work well, you need to do it in advance, fairly significantly in advance, because new tax codes start getting issued around late February, early March, and they will all include benefits if you've reported them on P11Ds. If you go payrolling, those benefits come out of your tax code. So that change needs HMRC to have time to do it. So the 5th of April probably is not the ideal time to be telling anyone, us to register you for it, which we should be able to do by then. But it's something to consider how you want to approach it when you will consider doing it. Everyone involved will need to establish systems to gather, record and submit information, because there's going to be a lot of information. We're going to need to work out how we can establish the type of benefit, how it's paid for, who procured it, and then apportion the cost over the various pay periods to make sure that the monthly submission is accurate and reflects the benefit being provided. And as employee education will be required, because employees' net pay will be potentially affected. Their tax codes will be affected. So they would have previously seen a benefit in their tax code. So if they went on the HMRC portal, look to see how their tax code was established, it would include things like a company car or medical health benefit or whatever. That will no longer be the case. So all that will be stripped out of those tax codes, because it's now being dealt with through the payroll. So tax codes change. So, and letting people know that it's being done, how it's going to work, what does it actually mean, this payroll in the benefit, how does it apply to me and the benefit that I receive. So yeah, lot to be chewed on there. We're doing a separate webinar at some point. I haven't got the date in front of me, but we are, to start to address this, we're going to need to work closely with yourselves and our colleagues in the payroll industry to keep abreast of the way things are working, how development is proceeding. So it's interesting times, big thing. If you don't provide any benefits in any shape or form, then lucky you. You should be okay. But it's a lot of people, private medical cover is definitely more common. Lots of people start to provide that. They didn't provide it previously. So that's that slide. So that's pretty much it for imminent and absolute certain changes. So those are all things that have happened, or in the case of payrolling, are going to happen. There are a few things that are in the air, floating around, waiting to land at a convenient point. Probably depends on who's in government and what the political priorities are. But automatic enrolment pension changes. This has definitely gone through, the various stages of parliamentary debate, and is in what's the word? Anyway, it's been agreed. It's there. It's in legislation. So at some point it could drop with relative ease, and it's the extension of AE to workers aged 18 and over. So makes perfect sense, no question. The younger you save for your retirement, the better off you'll be when you finally retire. So it's a great idea. Obviously, younger workers will mean more workers, more employer contributions, so there will be a cost somewhere along the line. And abolishing lower earnings limit for contributions. So where employers use automatic enrolment qualifying earnings as their pensionable pay definition, there will be a band of earnings upon which nobody pays pension contributions currently. So it's £520 for a monthly paid worker, £120, I think, for a weekly paid worker. So if you abolish the lower earnings limit for those contributions, then both employee and employer will be paying more. From a, an operational perspective, it again, it simplifies matters a little bit. At the moment, it's quite difficult to explain to a worker who you're telling their contribution rates are 3% from you and 5% from them. Why does it appear on my payslip as 3.83%, sir? Excellent question. And it's all about that band of earnings upon which no pension is paid. So it'll make things a little bit simpler, easier to explain. But it makes sense. It extends to a wider range of workers, and it means they contribute more money to their pensions. So it has to be viewed as a good thing, I think. And then changes to the RTI FPS hours worked information. So you may be blissfully unaware of the fact that in RTI, when it was originally conceived and implemented, there was within the RTI submission, you would define for each worker what their hours worked were in terms of a band. So there were various bands relating to, full-time, part-time. They were banded, about 4 bands, I think. They foolishly provided a band other, which pretty much everyone, all payroll providers, has used because it's quite difficult in some scenarios to know what that band is. And if someone changed their contract, then their hours may change. Would their FPS be updated? Sometimes we struggle to get the basics of payroll information. If their hours have changed, then we might not know about it. So I think this is I'm quite surprised that they're talking about it as if that wasn't there, because it's always been there. But they are talking, and it is expected in 2025 that increased data gathering via the FPS will become a thing. So we, as your payroll provider, will be required to give more information about the hours that were worked in that pay period. So it's just one for the future to be considered. Other changes over the years since RTI was introduced, particularly the Taylor report and stuff, which nowadays it's a requirement that you provide more information on pay slips. You record the number of hours for hourly paid workers. You don't have to do it for salaried. So there is more information that is become part of payroll over that period of time. But there's certainly some work to be involved. I mean, there's obviously the great debate about liberties and all this information that Big Brother might be getting on you. So there's certainly things to be talked about and addressed, but it's on the horizon. So yeah, like I say, it was a bit of a dull year, so I thought I'd pitch it in there. So that's that slide. Just a big up for our webinars. So if you've enjoyed today, then you might consider some of our other webinars. If you haven't, you might still consider them, because today's was a bit of a dull subject matter, really, wasn't it? I mean, what can you do with tax and national insurance? Whereas workplace pension clinic for employers, you can go everywhere with that. We love pensions. I regularly say that what used to be payroll and pensions has over time morphed into pensions and payroll. I think the predominance of pension conversation, questions and queries indicates that pensions are a far bigger area than they ever were before. And when we talk about the definition of pensionable pay, is it AE qualifying earnings, set 1, set 2, set 3? People glaze over. And then we start to talk about relief at source schemes, net pay arrangements, salary sacrifice. Then you suddenly realize that there's a hell of a lot to this pension thing going on. And yeah, we would like to open the doors, open the box and let people see inside, because I think it's so crucial for people's well-being going forward that they understand pensions. And they need to understand it, because you as employers basically can't influence them in any way, whether they should or shouldn't be in a scheme. So they have to make decisions for themselves. So being able to give impartial, kind of factual information to employees is a big thing. Top tips for smooth payroll processing. Sounds exciting. We'll love that. Dealing with HMRC in terms of PAYE discrepancies, we get plenty of those. accurate reports and ledgers. So, using the information we give you or could give you sensibly and effectively. Got payroll and benefits. It's at the bottom of the list. I don't think it'll be at the bottom of the list in terms of the timeline. But yeah, there's lots to chew on there. We enjoy doing them. We love it if people turn up. So if there's anything there that takes your fancy, or you've got any great ideas for future webinars, then we're always keen to listen, because we just want to open up some of the mysteries, the secrecy surrounding payroll, so that people better understand it. That's our mission in life. So that's that one. So I think that ends the webinar. So we'll open the floor briefly, either to say goodbye or to ask a question. If it's something that is specific, then obviously all the other routes exist. So you can give us a call, or you can email, or whatever. But yeah, thank you very much for your time and attendance. Hopefully you found something there that was of interest, or something you didn't previously realise. I know that there's so much information surrounds the budget these days that people know it before it happens. So finding a surprise, we can't find a rabbit out of the hat because the chancellor couldn't do it. So but anyway, there's a few things there that are occupying our minds, and we hope will be of interest. So thank you very much.